Hello everyone, and today I'm going to go over how speed runs, as I'm calling them, are put together. Now, what a speed run is it's just for the purpose of the investment club, and pretty much what we're trying to do is build a mock portfolio, baby steps at a time. So instead of doing the whole 9 yards when it comes to how to build a portfolio, I think it's best if we just get some experience following stocks. So that being said, we're going to start off with just like very simple ways to get stocks on your radar. In reality, what we would do after getting stocks on our radar is do a lot more research on them and their competitors. However, for the purposes of just getting a portfolio started, so we can see how it's used and how get the experience of following the stock, we're just going to simply take this speed run, as I call it. Other people would just call it, initial industry analysis, and we're just going to dump them into our mock portfolio. And again, in reality, especially if you're using real money instead of a mock portfolio, you would make sure you do a lot more research. But anyway, so I'm just going to use the example of consumer discretionary. As you know, we're just a very basic idea here, trying to beat the S&P 500. S&P 500 just being the main standard of what the stock market is, at least in the United States. So, as you know, the S&P 500 has multiple sectors, just breaking down stocks by what they do. And the consumer discretionary, just as it sounds, what consumers spend their money when they have just extra money. So, not to be confused with consumer staples, which is what consumers have to buy: rent, clothes, food, water, shelter, all that kind of stuff. Whereas consumer discretionary is going to be more like jewelry, fine clothes, art, things like that. So anyway, as you can see, step one is to see where the sector is as a whole. So just go over to Google Finance and look at an ETF. An ETF stands for Exchange Trade Fund. All that means is a bunch of people have gotten together, bought stocks that relate to each other, and name it an ETF. Like, for example, they might say, and when I say they, I just mean any type of bank out there or financial company. They'll say, hey, listen, these consumers want to get exposed, want to buy into a very wide category, broad category of stocks. So what we'll do as the company is we'll buy all of these stocks, and then we'll bundle them together, and then we'll make a security, an ETF, based off of that bundle. So for example, let's say JP Morgan says consumers, people out there want to invest in the consumer discretionary sector of the S&P 500. But the consumer discretionary sector may have tons and tons and tons of stocks in it, and the average person may not have the funds to buy into every single one of them. So what they do instead is JP Morgan buys a proportional amount of all of those stocks, and then you can buy into that fund, and that's called an exchange trade fund. Very similar to a mutual fund, except ETFs tend to be a lot more transparent, and a lot of them tend to be a lot basic. So a mutual fund tend to have like active managers who are trying to make decisions on how to maximize a portfolio, whereas an ETF, especially ETF based off of the sector, this ETF is just going to buy exactly what's in the S&P 500 consumer discretionary, exactly how the S&P 500 has it as far as market weights. So if, for example, Signet, a jewelry company, is only 1% of the S&P 500 consumer discretionary, this ETF will only have 1% of their funds invested in Signet. So anyway, I use Vanguard consumer discretionary ETF. There's a bunch of different companies out there that make pretty much the same thing. I just by hobby, just by habit, use Vanguard. Just because they tend to actually have very low fees if you ever actually go out and buy an ETF, shares in an ETF. So as you can see here, Google Finance, we're invested or looking into consumer discretionary. So we have the consumer discretionary ETF here, which is essentially, again, this ETF perfectly mimics how the actual sector is doing. So all you would need to do is see if you wanted to see how it was doing one day. 0.15%, you can do 6 months, and then all the way up to as long as they've been keeping track of it. So, as you can see right over here, I just put in the performance, a 5-year performance, and then this is a compound annual growth rate. Now, I shared this document with you on Google Docs, but a compound annual growth rate just says this. If you were to take this 5-year growth rate, which is, the total growth over 5 years, how much would you have to get a return on average each year to get the 5-year? So, and remember, this is dealing with compounding money here, compounding cash flows. So you can't just simply divide this number by 5 and say, oh, that's the annual performance. Because again, year 2 is going to get a percentage increase on not just year 1, but the percentage increase in year 1. And basically all this is you take the ending value, which if it's 88%, 188, divided by the beginning value, just base of 100, and take it to the power of how many years 1 over how many years you're dealing with. So in our situation, 88%, 188 divided by 100, we're looking at a 5-year growth here. So to the 1 over 5th power is 1.33. Now it's not 113%. It's you subtract 1, 13, around 13, 14% each year. Now to give you a perspective, the long-term S&P 500 growth rate, now this is really long-term, is 10%. So what you would do is you'd figure out a compound annual growth rate for all of the sectors. But in this case, right now we're just dealing with breaking it down sector at a time. And then you also look at the recent performance. So you look at the recent performance as well. And then also look at the performance of the S&P 500. Because remember, you can't really call anything good or bad in finance. It always has to be related to something. This stock had a 5% return this year. Is that good or bad? Well, it depends. If its industry sank 10%, every other stock, its competitors sank 10%, a 5% increase is really good. However, if everyone else did 10% better than the 5%, then it's not so good. So you always have to remember, compare something when making it good or bad. You can compare the sector to itself. You can compare it to the S&P 500 or other sectors. For me, I said, let's look at it compared to the S&P 500. And again, I'm just saying, remember, good or bad. And evaluation, recent performance has been poor, which means there might be a chance to buy an undervalued stock. Because remember, the classic, buy low, sell high. If things are doing horribly, then if you run an analysis and you say, okay, it recently dinked, but now I think it's going to go back up. So that's, don't just say, oh, it's been performing really well, so we need to get invested in it. In fact, a lot of financial analysis would say, oh, that's the time you should be selling, not buying. And again, we should always just keep our sources available right down here. I mean, that's just me copying those sources. Step 2 is find out what companies have done best in this sector and which ones are top rated. So the deal is, if we go up here, we're going to use Morningstar right now, which is just a market research site. Our school, John Carroll, pays for us to have a subscription to that, so essentially we need to go through the JCU library. And they recently changed how to get to the academic journals and resources here. So this is a little bit weird, but just follow the steps. So this is how I do it. I'm sure there's another way, but I go to the library, to subject guides, A to Z list, and then we're looking for M for Morningstar. And then if you're off campus, you'll have to sign in. Just your normal how you sign into any computer, John Carroll. Anyway, so then what we're going to do is you're going to go to markets. And here we go, sector reports. So Morningstar calls sectors sometimes different names, but they're essentially the same thing. So consumer discretionary is the same thing as consumer cyclical. Why? Because it's saying when the economy is doing really well, consumer discretionary should be doing really well. Where it's doing really poor, contrariwise, the sector should be doing poor as well. So the cyclical cycle motion. So we just hit that. And then this will give you updates on the sector. And now, again, these are professional people who are just paid to talk about what they like about the sector and what they think about it. And let me see here. Then if we go back to the home page, hit sectors there. And again, just if you need to slow down and pause and look exactly where I'm clicking, just feel free. In sector returns. So, wait, consumer defensive. We don't want that. We want consumer cyclical. And here you can see these are all the stocks Morningstar looks after, and the consumer cyclical, well, pretty much every single one almost, and they're being rated by, right now, their 3-month return. But if you want a 1-year return, you just hit 1 year. Now they're in order of 1 year. You could do the same with 3 and 5 year. So looking at the 5 years return, okay, Tesla Motors is doing extremely well. O'Reilly Automotive doing really well. Home Depot, etc., etc. So basically, what I said is you should find a list of the best past performers. Now, I did this a little while ago, and I think I based it off of 1-year returns. Maybe 5-year returns might be better. Or honestly, both would be really good. But you normally get more information out of 1-year returns just because they normally did something really well that 1 year. But looking at both is probably the best. So making a list of the stocks that have done extremely well, and then after you do that, I also like to look at ones that are top rated. So this is a stock screener. Right now all I'm using it for is to try and find the top rated. So basically you screen all the stocks Morningstar has in its database by these characteristics. So I want a sector. Sorry, it takes a while. To be consumer cyclical. Okay. I also want it to be, let me see here, market capitalization. Remember, we're going to try and beat the S&P 500, so we want stocks that are in the S&P 500. Market capitalization greater than, which means large cap stocks, which means bigger than, these are in the millions, so bigger than 10 billion. Also, what we're going to do is we want them to be domestic in the United States, because again, the S&P 500 is stocks, American stocks, United States stocks that are above 10 billion in market capitalization. And again, we're looking specifically at the consumer cyclical sector. And then for the top rated, all we're going to do is we're going to go down Morningstar rating greater than or equal to 4 stars. And right now you can see 18 stocks pass our screen right down here. So when we hit this button, it's going to run this. It's going to look at all its database of the things we talked about in 18 stocks. As you can see, Amazon, Expedia, Ford. And remember, a lot of these will probably be different than the ones over here. Because again, a lot of stocks act in cycles. So if a stock has been doing really well recently and people put a lot of money into it, there's a really good chance it's now at a fair value of what the stock actually is. And we'll get into later what that fair value means. But again, just remember, a lot of stocks act in cycles. And a lot of the time, to buy low, you have to buy it when everyone has recently sold it. You can't just buy stocks that everyone else invests in, because that's, that'll get rid of a lot of what finance people call alpha, just the stock performing well. But anyway, so I get this list of companies that have done well in the past and companies that at least Morningstar expects to do well into the future. And then what I'll do is companies, I'll go over here. One, just to get an analysis, you can look at, let me see, like Disney. Just search the specific stock, normally by its ticker, and you can actually go over to stock analysis, and they have a professional analyst giving an analysis of this company. And hopefully they'll give a reason. As you can see, it's rated 4 stars, a buy rating. You can hopefully see, oh, these are the things that this group is talking about. Sometimes it's just the fundamentals like revenue, expenses, etc., etc. Go down their investment thesis, why they think Walt Disney is deserving of this 4 stars. And then also a really good thing to do is go to sec.gov. I'm just going to use Disney as an example. Go to company filings and put in the ticker. And then search for their 10K. Documents. Look at the full document. And then this is, the Walt Disney's 10K. And then what's a really good thing to look at is, let me see, management's discussion on results of operations. So as you can see here, management is going to talk about the things that they think they did really well this year. And remember, especially for companies that have performed well in the past, maybe not as much some of the companies that are just expected to do better in the future, but honestly, it's good to look at a professional rating, an analyst, but also go in and look at what management is saying, because in my opinion, this is just one of the things I believe in. If the stock price has been doing extremely well because management did something good, management is going to tell you about it. So here you can see they'll talk about they mention a lot of things, the analysts, and they'll probably break it down, costs and expenses. And again, also relating this to the general industry or sector analysis that I showed you at the very beginning with Morningstar. So going back, this is hitting sectors right here is how we were able to get to the returns. But if you hit markets and then hit the actual sector you're talking about over here, this is how you'll get the thesis or the research, what Morningstar thinks about the consumer cyclical. So anyway, going back over here, you can see, and you see I have the source right here. Oh, this is where I got. And then step 3 is to analyze why these companies are doing so well. So after you sort of look over what the analysts are saying, what the management is saying, what the industry or sector as a whole is talking about, maybe even Googling news articles as far as, hey, what's up with this company? In fact, to show you an example, going back to Google Finance, if we just choose any stock, again, I'm just doing Disney for sake of example, they will have a chart talking about, how the stock is performing, but also, as you can see right down here, on this date where there was a drastic change, these are the things that were in the news about this company. So as you can see here, there was like a brief little jump and then a downtrend happened. And especially here too. So what was in the news about the company at that time period? And then recent news articles are always just down here. And this is just ordered from most recent to in the past. And they're just organized by letter. So yeah, and looking in the news either just through Google Finance or through any other type of news source. And then you just pretty much, this is where I think we can add value as a club. Because when it comes to really technical models and, computers and number crunching and expert statistics, right now we as an undergraduate club won't beat people, won't add value in that area. But where we can add value is a critical, I hope I don't sound too much like your philosophy liberal arts professor here, but we can add value by using critical thinking to analyze, why are these trends occurring? And this is where there's 1,000,001 opinions out there. A lot of different people will blame, but say a company is doing bad or, are good, or the sector is doing poorly or great, based off a bunch of different factors. And this is where we can use our strong background, economics and business sense, and this is where we can have an advantage, because a lot of the time professional banks and people, it's a very high stress, very fast paced industry. They don't have time to look too deeply into things, and also they're very structured. You're only allowed to look at X, Y, or Z thing. But us, we're allowed to step back and say, well, let's try something new. And again, there is no set formula to this. It really is just, hey, I'm picking up information here. A lot of people are talking about this. Let me figure out why, and let me get an analysis of why. And this is where it's just using a lot of logic and business sense. Like, okay, this company says they've been performing well because of this, and so do these other companies. So for me, when I was doing consumer discretionary, I just found a lot of people really liked pumping online sales. So a lot of people are really interested in, hey, online sales are a good thing. They're lower cost. You get a wider group of people. It's easier to target customers you want. So I said something that's correlated with that is probably going to be a good research and development budget, maybe a marketing budget. Emerging markets were another thing that every analyst and 10K was talking about. Oh, we're doing extremely well in emerging markets. And vertical integration of a service. So, for example, Priceline offers hotels for when you get off the plane. That's the vertical integration. And so then I looked at all of these factors, and on top of those factors, so I looked at the factors that I thought were doing well, and I thought, what are some ratios or aspects in financial statements that sort of correlate, with what these people are talking about? Sometimes it's really obvious. Sometimes an analyst or a management discussion analysis will say, well, we have an extremely small percentage of sales, bad debts expense or something like that, which is like really important when you're looking at hospitals and universities and things like that. Is allowance for doubtful accounts. And again, I can get into that later, but still, sometimes just management and analysts talk about very specific financial statements accounts, which is really good. Sometimes they don't. Sometimes, like, for example, everyone was talking about, oh, they're able to boost their online sales. So for me, I said, well, what would make sense? What financial statement account would be correlated with good online sales? Probably marketing and research and development, because they're trying to increase this huge marketing section, essentially, of their business. And then also, you want to look at what I would call value as well, which is saying, hey, what is their actual revenues and expenses compared to the stock price? Now, like the basic classic example of value is earning per share. I don't like EPS because it's extremely manipulatable by corporations. But another good one is like price to book, not price to earnings, price to book, cash flows to book, things like that. So then I just threw them in a stock screener, which is, again, I showed you how that went. So let me see here. Where did I put that? Oh, I don't think I put an analysis or a copy of what I screened for. But again, I showed you stock screening. It's just going back to Morningstar. You hit screen for funds and search for data points. So here's a list. Well, never mind. Start over. Anyway, I don't know why this is giving me grief now. Anyway, sorry about that. I'll look into that later. But I guess you could just use this here. Rolling portfolio. But here are like all the different things that you can screen for. Oh, you know what? Companies. I hit screen for funds instead of screen for stocks. That's why. View data. Okay, here we go. So as you can see here, this is a huge list of all these different things you can screen for. Pretty much every financial thing you can think of. Return on equity, return on assets. Those are good value ratios in the company. Just how much income can they squeeze out of their assets? Essentially, how efficient they are with using their assets or equity. Debt to equity, financial leverage, all that kind of stuff. So then what you'll do is after you run that analysis, you'll throw in some of your quote-unquote growth aspects, which are, hey, what are companies doing well? And you'll throw in some value aspects, which are just looking how is the stock priced compared to its actual assets and returns on equity, and, how well it's doing efficiently, getting revenue up, expenses down, things like that. So, and again, if you're ever uncertain, you can just go to Investopedia, value ratios. And you can see, like right here, per share, price to book, price to cash flow, all of these classic ratios. And it gives a little explanation of, why. Why are these ratios being looked at? And again, on a theoretical level or a philosophical level, it's just saying the only thing you really care about is profit coming from a company. So you look at their profit compared to how much you're paying, but there's a lot of ways to slice and dice that. So sometimes it's how profitable compared to how much resources they have. Again, price to book, asset or price to assets or something. How much income can they squeeze out of what they have? Efficiency. Sometimes it's just how much income you get compared to how many share, what the price of the share is. So again, you throw both of those in the same screen for a stock, and then basically what I did is I just said, took the first 5 companies that jumped out at me, and I said, these are the stocks we're investing in. Now again, normally in a real portfolio, you wouldn't just say these are the ones we're investing in. You would say, okay, based off of looking and screening, getting an understanding of the industry, while also trying to retain some sense of like valuation, these are good companies to begin to look at. We should also look at their competitors. And then you do a very in-depth analysis of these companies and their competitors, and then you make a final decision. However, again, this is just to get the idea, get the companies on our fake portfolio just to look at them. So you basically, if you can just come into Investment Club, as you can see over here, these are, pick a sector. Not all the sectors are listed here, but pick a sector and say, this is the sector I'm going after, run this analysis, and find these couple of companies. And again, I call it a speed run because it took me like 1 or 2 hours to do this. So again, the goal is just trying to get the stocks on our books and everything. Again, fake books. I don't recommend you doing this in real life and just investing off of this basic analysis. But that's pretty much how we run this analysis. So I hope you found it useful. Please email me if you have any questions, and I hope to see you at the next meeting. Goodbye.